Hi, I'm Louis Foxwell, a research analyst here at Horan Capital Management. Welcome to our 2018 fourth quarter market commentary. As the new year begins, we look forward to the potential opportunities and challenges that it will bring. At the same time, we believe that it's important to look back and reflect on the past year. That reflection will be my focus today. So let's start with bonds. Overall, bonds, as measured by the Bloomberg Barclays U.S. Aggregate Bond Index, ended the year roughly flat after a strong performance during the fourth quarter. Now, U.S. large-cap stocks, on the other hand, as measured by the S&P 500 index, were down 4.38% for the year. This was the first year since 2008 that this basket of stocks saw a negative return, and it was driven by a very tumultuous fourth quarter. In fact, if you refer back to our previous video, the index had been positive going into the fourth quarter. So what happened? Well, it mostly came down to December, which was the worst December for U.S. large caps performance since 1931. We sent you a brief note during the month discussing the volatility and performance drop that we were seeing. To get a little more specific, though, there appeared to be a few catalysts for the decline. The first was the inversion of the Treasury yield curve at the beginning of December. This happened when the interest rate of the 2-year Treasury bond rose above the rate of the 5-year bond. Now, this is considered a partial inversion, and we saw partial inversions occur on different points of the curve throughout the month. But why does this matter? Well, because a full inversion of the yield curve has historically preceded recessions. And a full inversion would be marked by the rate of the 2-year bond rising above the rate of the 10-year bond. Now, this did not occur, but the partial inversion was definitely notable for investors and contributed to the negative sentiment in our opinion. Now, the second catalyst in our view for the negative quarter was the Federal Reserve's decision to hike the Fed funds rate another 25 basis points and their indication that we could see multiple hikes in 2019. We've discussed rate hikes in the past, and you can refer to our last video for more details. But the most important thing to remember is that rate hikes generally put downward pressure on asset values. And this appeared to be the case last quarter. Combine this with the unorthodox yield curve, and you can see why there might have been supernormal volatility. Now, the third catalyst that we see as a potential contributor to the negative quarter was the trade war with China. Tariffs have made manufacturing more expensive for some companies, and we are seeing those effects in those companies' share prices. Furthermore, investor sentiment over the United States' long-term relationship with China seemed to change by the day as news flowed into the markets. Now, I've mentioned 3 catalysts today that we believe contributed to the market sell-off during the quarter. But I should note that while these were the most glaring factors at play, other variables may have also had an effect. For example, fund managers may have engaged in what we call window dressing, which is where they sell their losing positions at the end of the year in order to make their portfolios appear more attractive. Another example would be tax loss selling. The list of potential variables goes on, but the main point that I want to get across is that we are monitoring these variables at the same time that we are maintaining our bottoms-up investing approach. Now I'm going to let our other research analyst, Matt Holman, comment on that approach before we conclude the video. But I want to thank you again for watching this video. And I want to wish you all a very happy new year, and I look forward to seeing you again next quarter.
Thanks, Louis. Hi, I'm Matt Holman, a research analyst here at Horan Capital Management. All the short-term economic headwinds Louis discussed are important to have in the back of your mind. But remember, we're focused on individual companies, more specifically, high-quality businesses selling below their intrinsic values. We cannot control the yield curve, the Fed's decision-making, or the trade war. What we will do, though, is remain disciplined during these times of heightened volatility and use it as an opportunity to invest in high-quality businesses at attractive prices. This will be our focus going into the new year, as we stay true to our long-term, value-oriented methodology. Don't forget to review the quarterly portfolio activity, which is posted on our website. If you have any questions, please don't hesitate to reach out to your financial advisor. Thanks again for watching. We look forward to seeing you next quarter.